So we're going to get back into Chapter 10, um, accrued liabilities and short-term liabilities and contingent liabilities for businesses, and continue with basically our crash course of payroll um, accounting and the journal entries associated. And so just as a reminder, when recording payroll, we have the employee wages, we calculate overtime, we calculate Social Security tax, Medicare tax, the federal withholding tax is given to us, and then there's the employee portion of Social Security and Medicare, the employee's federal withholding, and then Social Security tax and Medicare tax paid by the business, which is 6.2% for Social Security. Medicare is 1.45%, but on the homework and quizzes, it's simplified to 6% and 1.5%, unless it says otherwise. And then so then the unemployment taxes, these are paid by the businesses, not by the employees. And then we make a big journal entry for the wages payable, and we can separate based on the class of employees. So we know our factory expense, sales expense, office expense separately. And then all the payables are to different tax agencies or whatever. And then, medical insurance, union dues, and then salaries payable is the net pay that gets paid to the employees. And fringe benefits, we also talked about vacation pay last week or last Tuesday. And companies do have to record vacation pay expense and vacation pay payable for any accrued vacation days that are owed to the employees as of the end of the period. And it's a current liability, assuming that the vacation is expected to be used in the current year. Employees might be required to take it all within 1 year. And that can make it simpler to know that it is a current liability. However, if somebody has accrued a exorbitant amount of vacation over their time and they're not going to use it in the year, then that portion would be a long-term liability. And pensions. So pensions are cash payments to retired employees, and they're accrued by employees as they work based on the pension plan. And there's two basic types of pension plans. The first is a defined contribution. This is like a 401k, where employer and employee both contribute money to an investment plan, and however well the investment does, that's how much the employee is going to get at retirement. So for example, at my accounting job, I contribute, 6%, and then the employer contributes somewhere between 4 and 5% as a match, and then the employer portion can vest over a period of time, and then when I retire, the amount that investment has grown to, that's what I get. And I can choose what kind of investments I'm putting it in. And it's nice for employers because they know exactly what their expense is. And it's not going to become a problem later, because when it becomes a problem is when it's and so see, it's very simple. Every year we just have pension expense and cash. And the pension expense is the cash that the company contributes to the 401k, to the pension plan. It's simple. Whereas a defined benefit plan is promising a traditional pension. If you work here for 40 years, you're going to get $1,000 a month in retirement, or $2,000 a month in retirement, or a percentage of your salary until you die, or something like that. And that's a lot more complicated to estimate, because what a company does is they contribute money every year to a pension fund, and that's supposed to grow. So by the time the employees are retired, there's enough money in the fund to pay out the benefits. And it doesn't always happen like that. And that's really what led to the demise of Northwest Airlines, is they had this huge unfunded pension liability, and they went bankrupt because so many people were retiring, they couldn't pay the benefits. And it really is just poor planning for that to happen, or poor investment performance from the pension funds. And it's a lot more complicated to estimate what is that future liability and then making sure that the pension is funded accordingly. So this is the journal entry to record the pension. I mean, pension accounting can be quite complicated, and we're going to simplify it for the purposes of this course. They basically will tell us that December 31st, Hinkle pays $60,000 to the pension fund. However, the annual pension cost is $80,000, and so we credit cash for $60,000, and we credit underfunded or unfunded pension liability of $20,000. Pensions are also a way companies basically kick the can down the road for these fringe benefit expenses. If they know their actuaries have all these tables, they know when people are going to die, they know how long people are expected to work at the company, and so they can estimate how much is it going to cost at the end, and then discount it back to the present using, okay, we estimate we're going to make 5 to 8% on our investments for the next 30 years. And they know, the actuaries tell them that your pension expense is going to be $80,000. However, the company only contributes $60,000. They leave $20,000 unfunded. That $80,000 is still the expense. And then that $20,000 becomes a liability. And there's a lot more other accountings that we could go into, but that is simply what this, if you're interested in more of how this works, I'd recommend pursuing accounting as a career, and then in intermediate accounting 2 especially is when we would get into pension accounting for all the liabilities and calculations there. There can also be post-retirement benefits other than pensions, like dental care, eye care, medical, tuition assistance. And for example, airlines, oftentimes if you work for the airline for 40 years, even when you retire, you get free flights for life on standby. And that's a cost, that's a liability to the business. And so we have to estimate that in some way, and that would be included in whatever liability is there, so that it can be expensed in the current year when the employees are working. That's the whole point of all of this, is to match this pie in the sky pension expense in the future when these people retire and are going to get paid the benefits. We have to match that expense to the actual years that they are working. And it's also important, so for example, at Anoka Ramsey, you can choose when you work here, whether to have defined contribution or defined benefit. And me making that decision, and for you guys, if you ever come to this place in your life where you have to choose between defined benefit and defined contribution plan, it's all about the money. How much money is going to be contributed to defined contribution compared to how much money is going to be contributed to defined benefit, project it out into the future, and calculate what's the investment return promised under a defined benefit, and that's a guarantee, so knowing that it's risk-free should be considered, right? Like that's worth maybe taking a little bit less of a benefit if it's guaranteed, compared to what do you expect to make on the investments in a defined contribution plan. So it's all like, one's not, to me personally, one's not better than the other. It just depends on how much benefit am I going to get in retirement from each of these plans. So and under the term, so in the recent year, Procter & Gamble showed an underfunded or an unfunded liability of 5.4 billion and a periodic cost of 340 million. So the underfunded liability, that's the amount that the pension obligation, which is determined by the actuaries, exceeds the actual value of net assets or investments in the pension plan. And then the 340 million periodic pension cost, that is the cost associated with this year, and that's what's going to show up on the income statement as pension expense, as part of salaries, right? So, and the both the annual pension cost and the total underfunded liability, that's all determined by the actuary's report, life expectancy, employee turnover, expected compensation levels, and then the interest that the fund is going to generate on the net assets of the pension fund. Any questions about pensions? Great. Installment notes. So now we're shifting gears back to the notes payable, in particular, installment notes. And this is something like a mortgage or a car payment. There's payments every month or every 6 months, and there's part of it that is principal, part of it that is interest. And at the end of the note's term, the principal will have been paid in full, and usually it is to purchase specific assets like equipment or property. And for example, we have an installment note issued January 1st for Lewis Company, principal of $24,000, interest of 6%, 5-year term, annual payment of $5,698. And a lot of times these annual payments will be generated from some calculator or a table that determines this is the principal amount, this is the term, this is the interest rate, and then the annual payment is what's the equal payment over all the years that's gonna, how do we divide the payments equally so that at the end, the principal is zero and all the interest has been paid. So initially we get $24,000 cash and then a credit to notes payable to create the note. And then each year, at the end of each year, we pay $5,698, and then we have to attribute how much of this was interest and how much of this was how much of it was principal paid. And so $24,000 times 6% is 1,440. That's going to be our first year interest expense. And then the principal amount would be the payment of 5,698 minus the interest paid, which is 6% times 24,000. So the principal payment is $4,258. So our journal entry would be credit to interest expense for the interest expense, credit to notes payable for the principal payment, and then a debit to interest expense, notes payable, credit to cash, because our cash payment is the same in each year. However, the interest expense goes down because the balance of the notes payable goes down every year, and then the principal payment portion goes up every year. And then we calculate the interest based on the carrying amount as of the beginning of the period. In this case, their annual payments, so it's the beginning of the year. And this is our journal entry. And then, so this is our journal entry in the first year. Journal entry in the 5th year has less interest expense, more cash. And then at the end of the final year, the carrying amount or the value in our T account for our general ledger of the notes payable is going to be 0 because it's completely paid off. And then I don't know what's going to happen after that, but for that would be the final entry for this notes payable. Based on the allocation of periodic payments for an installment note, which of the following is true? What will the payments contain? So B, exactly. So a larger amount of the interest in the earlier payments of the note is going to be true because this is an installment note, so it's not going to be A. A is interest only payments. That'd be similar maybe to like a bond with a coupon. A larger in B, we saw that in the schedule, more interest in the first part of the loan because the carrying value is higher. And that's also why paying off a car loan or a mortgage up front saves a lot of money in interest because that balance is going to carry for a lot of years after year one. So paying off more of the note in year one saves more money on interest. And then it's not an equal amount of principal and interest throughout the payments because interest is on the carrying value more at the beginning. And then it's not smaller because it's larger. So during the first day of the fiscal year, Triller Company had an $85,000 note, 7-year, 7%, annual payments of $15,772. First payment is interest and principal payments as follows. So the journal entry will be, we get $85,000 in cash, so debit to cash, and then credit cash for the annual payment, debit interest expense, and debit notes payable. Then at the end of year one, our balance is $75,178. And so we multiply that by 7% and we get our interest on the following year of $5,262, and then our principal in the next year of $10,510. Then the current portion of the note payable as of year one is the principal portion in the next year. So that's really important to note here is that at the end of the first year, the total carrying value of the note is $75,178. That's going to be on the liabilities section of our balance sheet. But how we actually separate that between current and non-current liabilities is that the next year's principal payment is going to be our current liability because the second year interest, right? We know that the payments owed next year is $15,772, but that interest portion has not yet been earned yet by the bank. So this $10,510 is the amount that's actually included in the $75,000, and then the long-term portion will be the $65,000 that's remaining, so that the total of current and non-current add up to the carrying value. So we have to go a year ahead to calculate. So on January 1st, we issue a note, $175,000, 5-year, 8% to the bank, and annual payments of $43,800. So in the first year, we get the payment, we get $175,000, then we have to make a payment, interest $14,000, principal $29,000, and then year 5 paid the annual principal payment on the note, including an amount of interest. So in the first year, we have interest expense of $14,000, and then equal payments every year of $43,800. So if we know our final year interest is $6,253, we can take $43,830 minus $6,253 is equal to the remaining principal balance of $37,557. And this will, I mean, this really, it just takes practice to get this, to get these down. I would say that the homework this chapter is primarily focused on payroll and payroll calculations, but there is a problem on notes payable as well. So in this problem, we're asked to prepare a table for this installment note similar to the one shown before, and it's going to show every year what's our principal payment, what's our interest payment, what's the carrying value at the end of the year, and what's the total payment. For this note, it's 147,750, 4 years, 7%, annual payments of 43,620. And so our table that we create, we have 147,000 first year. The cash payments are the same every single year. And then the interest expense is 7% times the beginning January 1st carrying amount. And then decrease in notes payable is the cash paid minus the interest. And then we get to the principal amount that it goes down. And then we take the carrying amount minus the principal payment. And that gets our carrying amount on December 31st. And then that goes straight from December 31st to January 1st of the following year. And then, right, we start all over again. And also note that at the end of the first year, the current portion would be 35,607, and the long-term portion would be 78,866 at the end of the first year, because this is the principal amount due within 1 year, principal amount due longer than 1 year. So this would be current long-term portion as of December 31st, year 1. As of January 1st, year 1, current portion would be 33,277, long-term portion 114,000. And then these are the journal entries every year for this transaction. So 147,750, we receive the full amount on January 1st. Then every year we have interest expense gradually decreasing, notes payable, principal payments generally increasing, and then every year our cash payment is exactly the same. And the income statement amount is only the interest expense. That's all that's recorded on the income statement. Because if we think about, what's happening here, cash, taking out a loan, debit, cash, credit, notes payable, that's increase assets, increase liability. No change to owner's equity whatsoever. Interest expense is the only part of any of this that changes owner's equity. So there's also some liabilities that arise from past transactions that create what's called a contingent liability. And they're transactions that are going to occur if certain events happen in the future, or the liability for something is uncertain, or we're unsure if we're going to have to pay for something. And it is measured on the likelihood of occurring and the measurement. And so likelihood of occurring is, picture a lawsuit. Lawsuit happens. We don't know if we're going to have to pay for this lawsuit or not. So that would be a likelihood of occurring. And then measurement is how much is the judgment going to be for the lawsuit? So, and the likelihood of occurring is classified as probable, reasonably possible, or remote. And also in the remote, there can be, if a lawsuit is classified as frivolous in a legal letter or in legal disclaimer, generally that would be remote. However, and then the ability to measure the potential liability is classified as estimatable or not estimatable. So basically, is this event probable, reasonably possible, or remote? And then are we even able to estimate the measurement of how much it's likely going to cost us or not? And that determines whether we accrue for it, whether we actually show an expense for it, or whether we disclose it, or if we do no disclosure and no accrual. And if a contingent liability is probable and the amount can be reasonably estimated, then it is recorded and disclosed. Picture a building that has asbestos. We know that we are probably going to have to do a cleanup of that building at some point in the future. And the cost of an asbestos removal from a building, pretty easy to estimate. People do it all the time. There's contractors, they'll remove the asbestos, and so we have to, we have to record a liability, and assuming that it's a major thing, which likely it would be if it's an asbestos for a building that's a major piece of equipment, we would debit an expense, create a liability for the asbestos, and then we would disclose that in our financial statements. We estimate that this is what the asbestos is going to cost. So, for example, warranties. Companies that have warranties that we don't know whether the warranty is going to be used or not. Picture Polaris selling snowmobiles and four-wheelers and things like that. They have warranties on those. They don't know whether the warranty is going to be used or not, but probably some of them will have warranties being used. And so and it's similar to the coupon liabilities that we had in the previous chapter on retail transactions. They create a product warranty expense and then a product warranty payable, and then the warranty expense gets accrued in the period in which they sold the snowmobile. That's very important that the warranty expense gets matched to the sale of the product that had the warranty on it. And then the warranty payable gets created as people exercise the warranty, as Polaris has to pay out for repairing random defects or things covered under warranty, then the payable gets used up in the following periods. And so then when say that the spark plugs go out and they need to use up the warranty payable, they debit the payable and credit the supplies that they used for that. Probable and not estimatable gets disclosed. So because we're not able to estimate, we can't put a price on it. And then because we can't put a price on it, we can't record a journal entry. So we're not going to accrue it, but we are going to disclose it in the notes to the financial statements under contingent liabilities or whatever, and say at the end, so for example, an oil spill or a dumping into a local river, at the end of the period, the cost of cleanup is not able to be estimated for this particular liability. They don't know how much it's going to cost to clean up the river, but they do have to disclose that they know that they're probably going to have to, and that's an expense investors should know about that's going to happen at some point in the future. And the politics of being able to estimate or not can be quite fun. And then reasonably possible is a contingent liability may only be reasonably possible. And then in this case, the contingent liability is disclosed in the financial statement. So it's not probable. So whether it's estimatable or not, we're not going to accrue for it. Because it's not probable, it's only reasonably possible. But that's still a high enough likelihood that investors should know about this. And so say that there's a patent right lawsuit, verdict is under appeal, the company feels that it's possible that they're not going to have to pay it or that it's going to be significantly reduced, and so then they're going to disclose it, not accrue the expense. And then remote is if a contingent liability is remote, for example, a lawsuit for injuries incurred by skiers. In most cases, the courts have found that a skier accepts the risk of injury, especially in Wisconsin. I don't know if you've seen those disclosures, but holy crap. If you're trying to sue Trollhagen for a skiing lawsuit, you're not going to win. Like, there are so many disclosures. That would be frivolous. That would be remote. They're not going to accrue for it. They're not going to disclose it because it doesn't matter, right? There's no disclosure necessary. And so here's a nice little flow chart. There's the contingency, the event that may or may not happen. Is it probable? If it's probable, estimatable, we'll record a journal entry and disclose the liability. If it's not estimatable, disclose. If it's reasonably possible, we disclose. And if it's remote, we do not disclose. And this is all, the most common instance of this is lawsuits and environmental spills and cleanups and regulatory issues. And that's all related to legal things. And so what management will get is these big companies all have a law firm. That's their main law firm, and it's independent to them, sort of. And basically, they will get a letter from the legal firm saying, listing, literally, like if there's 60 lawsuits, every single lawsuit will be listed out. And then the probability of it being won or lost, and then the amount estimatable, then they would put an amount on it. Not estimatable, then they would say that it's not estimatable. And then as part of the accounting process, the accounting team would look over the whole list of lawsuits, make any journal entries necessary, and then any necessary disclosures would also be included in the financial statements. So if you work in audit.
Just to clarify with the example with the asbestos building, is
Yeah.
that something that you would only like do the recording and disclosure if it's something that you're not going to fix like within the quarter that you're going to be responsible for reporting the statements?
Exactly.
Okay. Like if it's done in that quarter, then
Yeah.
obviously you wouldn't need to do that disclosure.
Maybe. The disclosure, I'm not saying that the disclosure would, if it's a major expense, the disclosure might still be necessary.
Yeah, just differently worded.
Yes, it wouldn't say, it'd be this was a huge expense and is why we didn't make any money this quarter, not this is a huge expense and we're going to have to pay it in the future kind of expense. So yes. So if you work in audit, you will likely get to review some of the legal letters. And if you work for like a large Big Four accounting firm, you'll likely get to review the legal letters of some big companies and some big lawsuits. And it is really cool stuff that not many people get to see at the beginning of their career. So yeah, I mean, it's cool. It's cool stuff. So they'll list out every single lawsuit, the probability, and then the amount. And then that determines whether or not it's disclosed, journalized, all that. So yeah, if the lawsuit happens and it's paid in the current time, there'd be no liability, but it would still be an expense. You know, the expense would still be there. So, and generally with asbestos, it'd be when they find the asbestos, that would be when it's recorded. Yeah. And it's also interesting that the timing of all of this too. I don't know how much time we have. Yeah, we have time. The likelihood of occurring, that's determined as of when the financial statements are published. So let's say that there's a lawsuit that exists as of December 31st, and it's in court. And then the financials get published late February. But January 31st, the lawsuit gets settled or a judgment is reached by the judge. That information exists. And so if it was reasonably possible as of December 31st, but then the lawsuit actually gets a judgment on January 31st, financials don't come out until February 28th, the contingency just went from reasonably possible to certain because it happened. They now owe that money, and so then it would go into the probable, estimatable, record and disclose because they got the judgment, so it's certain that they will have to pay it, and then it's estimatable because the amount is now known, and then they would record and disclose. However, if it happened, if it was settled on in March, then it could still remain in the reasonably possible bucket. So for some examples, Ayers and Industries has a hazardous spill at a plant. They have a variety of issues, an EPA fine of $240,000. They're contesting it, but they think it's probable because it says probably the fine will stand. Employee is seeking $220 in damages. Counsel believes that, oh no, in addition, counsel indicates an out-of-court settlement of $125,000 has recently been reached. Think of that as lawsuit was settled after 12/31, but before the financials. The employee settled for $125,000. So then we know, and then they're also getting sued by a homeowner. They think that it's weaker and it's fairly frivolous or whatever. So that's remote. That'd be in the remote bucket. So their journal entry is going to be damage and fines expense, $365,000. And then EPA fines payable, litigation claims payable. EPA fine is the amount that they think is going to be paid, and then that's what the EPA charged them. Litigation claims payable, that's going to be the amount of the settlement, not of the initial lawsuit. So, and it would be included in probably other expenses, unless they had a reason to include it with a particular item. And then the disclosure that they would create is they'd say the spills resulted in a number of lawsuits. They disclose the EPA fine, disclose the out-of-court settlement, and then say there is one other lawsuit. Counsel believes it does not have merit. And whether, depending on how remote it is or how big it is, they may or may not even include that in this disclosure. And other lawsuits and unknown liabilities may arise that cover their bases, right? So there's a lot of contingencies disclosures, and no one is more proud of their contingency disclosures than cigarette companies, because cigarettes are terrible and vaping is terrible. So for example, Altria has a running, basically, account to disclose their lawsuit liability. And for example, there was a Juul lawsuit, and they said, this is the active ingredient, and it causes all these lung problems. And so they have an accrued liability in 2022 is 91 million, 2023 is 71 million, and then 2024 is 346. Is that, yeah, that's a million. No, it's 346 billion. That doesn't make, that might, oh, in million, 346 million. Thank you. Sometimes the zeros get a little confusing when it's that much money, but so then they had pre-tax chart. So then they actually paid out. So they have they essentially, what they record is beginning of the year, they had 91 million, and then they recorded additional lawsuits, and then they record their payments that they pay out every year, and then they have the accrued liability at the end. And then they also disclose, various amounts as to why they're getting sued for certain things, including the $1 billion lawsuit that came out a long time ago, since October 2004, the 1.1 billion lawsuit against the cigarette companies. That actually started in Minnesota. So yeah, so there's a lot of stuff there. And then, ExxonMobil, this is an example of them disclosing a litigation for their policy, saying only when it is believed to be reasonably possible or remote, then we're going to disclose it. And then basically they say that they're getting sued by the state of Louisiana for damage to habitat. And then they think it is meritless and represents an inappropriate attempt to use the court system. And so then they say, okay, they said it's meritless, they're not going to record it. And that's the determination of their lawyers. And of course, then the auditors are going to review the lawyer's legal note and get a bunch of statements saying, I swear that this is accurate. And then they're not going to disclose an expense, or then they're not going to record an expense, but they are going to disclose the ongoing litigation, depending on how likely they think it is or how big it is. For accrued product warranties, the company has a 1-year warranty, 2% of, and they estimate that it's going to be 2% of sales. And so sales were 1,800 for January. February 7th, a customer had repairs of 375 parts, $140 labor. Record the January 31st entry and the February entry. And also important to note, just for fun, the warranty is 1 year, so it's always going to be a current liability. Car companies, if they have a 5-year warranty, some of that's going to be a current liability, some of it's going to be a long-term warranty liability, because it's going to be more than 1 year from now that the warranty cost is going to be paid. So initially we have 1.8 million in sales. I guess it was different. Oh yeah, 1.8 million in sales. So times 2% is 36,000 in warranty expense. Warranty payable of 36,000. And then when the warranty costs actually come back and people have broken stuff, then we debit the warranty payable and then credit supplies and wages payable based on the cost of parts and labor. And the current and non-current portion does get separated. This is for General Motors. And they had sales of 127 billion and then warranty expense of 3 billion in the current year. And so then they have current year, current payable is 3.7 billion and then non-current 6 billion, total 9.7 billion. And it just has to be disclosed short-term and long-term so that we can properly analyze a company's ability to maintain, like to pay back its short-term commitments, long-term commitments. A short-term liability is a lot more urgent of a cash flow issue than is a long-term liability. Because long-term, I mean, that's tomorrow's problem. Like the company could be huge. It could be making a bunch of money by then. But if it's all due within 1 year, that's when companies go bankrupt, right? If they have a bunch of current liabilities that they can't meet. Okay, assume that the sales were 127 million, claims were 3.2 million. So what we could do is take the prior year, the difference between the current year and the prior year liability. So 9.7 billion minus 8.2 billion is about 1.5 billion, plus the amount that was actually paid out during the current year of 3.2 billion is 4.7 billion. That's the warranty cost actually going to be recorded in the current year for GM. And when reporting liabilities, we have to report the current portion and the long-term portion. So accounts payable, accrued liabilities, accrued payroll and benefits, income taxes payable, these are all going to be paid in the current year, along with store value card and other deferred revenue. So that's like gift cards, airline miles, prepaid contracts, a whole year of Xbox Live in advance. and then operating lease liabilities, current portion of long-term debt. And then long-term debt, long-term lease liabilities, long-term deferred revenue, and other long-term liabilities are all in the long-term bucket. And the contingent liabilities, for example, an asbestos liability, that could be long-term. If we know that the building has asbestos, but we're not going to fix it until basically we tear it down in 7 years, that's a long-term liability. It still is a liability. The expense was still recorded when we found the asbestos, but it's not an immediate liability. And so when we're making an analysis for the short-term liquidity of a business, there's 3 measures: working capital, current ratio, and quick ratio. And the working capital ratio, or the working capital isn't a ratio, it's an amount. Working capital is current assets minus current liabilities, and it becomes a dollar amount. It can be positive and it can be negative. So if a company's current assets are more than its current liabilities, then it will be a positive working capital. Negative working capital is if the liabilities are greater. And that's another balancing act on the security to efficiency, security of capital structure compared to the having an efficient capital structure. Are they efficiently using the cash to invest in the business? And then current ratio is current assets divided by current liabilities. So if working capital is positive, current ratio is greater than 1. Working capital is negative, current ratio is less than 1. It's never going to be below 0, though. And then a quick ratio is quick assets divided by current liabilities. And it's a much more short-term oriented measure than current ratio because it only includes the most liquid of the current assets. So it's like an even shorter term window. Quick assets are cash and other current assets that can easily be converted to cash, such as temporary investments and accounts receivable. Note, not inventory. And that's because inventory has a cost to sell. If a business is about to go bankrupt, struggling to make payroll, selling inventory has additional costs associated with it. And if they're struggling in all these ways, maybe they're not even generating operating cash flow. If they're not generating operating cash flow, how are they going to be able to pay their current liabilities without raising money from capital, from equity or debt? If they're not raising equity or debt, then how are they going to be able to pay? And if inventory costs money to sell, then maybe we shouldn't include it when we're analyzing the quick ratio, which is like a super short-term view. Is the company gonna solve it? And it's really only used in like emergency. It's like if an emergency is happening, they'll be looking at this ratio. Generally, for normal working businesses, we'll be looking at a current ratio to see how much risk are they taking. And the current and quick ratios are also, they're useful making comparisons across companies, industry specific as always. For example, we have Chipotle, we have Starbucks, and Chipotle has a working capital of 507 million. And we take current assets minus current liabilities for that. And then current assets minus current liabilities, Starbucks has 1.6 billion in working capital. And working capital is costly. It's super costly to have working capital because that's an additional asset that's needed to start a business. The most efficient business has very little capital requirements. That means they can make Like they don't have to pay as much interest on debt. They don't have as many investors to share the profits between. It's like think of Shark Tank when investors are they're all trying to invest as little as possible to get the most revenue. And working capital requirements are a barrier to entry for businesses. Think of like all the startup costs to buy inventory, have accounts receivable. Having accounts receivable is a cost because it's credit that's extended to customers. Cash that the business has to hold just to purchase in and out, like that's a barrier to entry to starting a business, is how much cash does the business have to have in the business bank account that's not going to be in the owner's bank account, right? So having less working capital to be more efficient, it's a barrier to entry. Current ratio, Chipotle has a higher current ratio and a much higher quick ratio. So and notice that the quick ratio is computed off of cash, temporary investments, accounts receivable, not inventory or other current assets. And then, so Chipotle has less working capital, but that's because they just have in total less current assets, less current liabilities. They're a smaller company than Starbucks. But comparing between the two, current ratio for Chipotle is more, quick ratio is more. Generally, they're in a similar industry, the restaurant industry. We could assume Chipotle is taking a more conservative approach to working capital management. They're holding more. A way to companies, right? Sometimes in debt covenants, they'll have current ratio requirements or a requirement to hold a certain amount of working capital. And so let's say that Chipotle is required to hold 500 million in working capital. If working capital drops to 400 million, what are their options? Really, the only option is to make money or raise money. So they have to either generate more cash from the business, which usually they wouldn't, if that was an option, they would have done it already. The real answer is borrow money or sell shares. That would be how they would increase working capital because it's increasing equity or long-term liabilities to increase current assets. It's raising cash while not raising current liabilities. And that would be how to increase the quick ratio, the current ratio, and working capital. So we'll have some more examples on the contingent liabilities. So Ayers Industries experienced a hazardous spill at one of its plants. Wait, we already went over this example. Anyways, so that is the material for Chapter 10, but are there any companies that you guys would want to take a look at the financials for? Maybe something related to payroll, contingent liabilities, long-term debt. They're a private company. I know. Okay, this is possible. Not if they are, if they're getting sued for laundering money. Yeah. Okay. Here we go. The mysterious Cheesecake Factory SEC filings. It's like they're a KPMG client. So this is important to note. If you want to work on the Cheesecake Factory audit team, you should move to Los Angeles and work for KPMG. That's your shortest route. Okay, let's take a look. Okay, so here is note 12, other non-current liabilities. They have non-qualified deferred compensation liabilities of $108 million. So that would be pensions for Cheesecake Factory employees. That would be included in deferred compensation liability, and then contingent consideration and compensation liability. This could be a contingent bonus, something that's also could be a contingent liability. It says, okay, if we make these performance targets in quarter 1 of the next year, then management's going to get an $11 million bonus. Whether that's probable, reasonably possible, or remote, that has to be disclosed, that has to be recorded if it's probable and estimatable. And it would be estimatable because we know how much that we promised to pay our employees for bonuses. So payroll bonuses, that can also be a common contingent liability. There are commitments and contingencies, so purchase obligations, including inventory purchases, and commitments are 147 million. And they're primarily due within 3 years. They're recorded as liabilities. There's also a contingent agreement based on an acquisition of FRC brands, including North Italia and Flower Child. I don't even know what those are, but do any of you know what those are? That's a common thing, though. If a company purchases a business, then they'll have contingent bonuses based on the performance of the business units after like 3 years after the purchase. And also the CEO of the business that gets acquired, a lot of times they'll be required to stay for 3 years. And if they do stay for 3 years, then they'll get a bonus contingent on that. And in that case, it wouldn't be recorded a third in each year that they stay at the company as compensation expense. But if there's bonus requirements based on the outcome of the profits of the business, that would be a contingent liability recorded based on how likely they think that is to happen. And then, oh no, on June 7th, the IRS issued an examination report for tax years 2015 to 2020, in which it disallowed a portion of our depreciation deductions for domestic production activity deductions, which is basically if you build, there are some special deductions for property investments in the United States. A lot of times it can be depreciated sooner, especially that, but pre-Tax Cuts and Jobs Act 2017 Trump tax bill, post 2017 Trump tax bill, and once again 2025 Trump tax bills. There's a number of considerations for property purchased for use in the US. And so the IRS took issue with some of it. It's in appeals, and based on the current status, we have reserved an immaterial amount. So essentially, they think it's probable. They do think it's estimatable. They created a small reserve, but it's immaterial, so they're not going to tell us how much it is. Which immaterial just means small. It's too small for us to care about. They also have private lawsuits. Looks like they're disclosing it. And it doesn't look like any of them are large or probable enough to show at this time that we believe that the amount of reasonably possible losses resulting from pending lawsuits will not have any material adverse effect individually or in aggregate on the financial statements. Individually meaning a financial statement line item level, so cash, accounts receivable, liabilities. Like they don't think that it's going to cause any individual things to have an issue, any individual segments. If a company has a bunch of business segments, not one business segment would be impacted. And then also in aggregate, it's also not going to be affected. And let's see, looks like the main contingent liability accrued for is management bonuses of 3.5 million. And then the executive officer specifies an annual founder's retirement benefit of 650,000 for 10 years, commencing 6 months after termination of full-time employment. So the founder of the Cheesecake Factory put into the policy that if he's fired, they have to pay him $650,000 every year for 10 years, even if he's fired. And that is fairly common for businesses if that happens, and that will be disclosed. Management compensation is usually disclosed. Well, management compensation particularly it's usually disclosed in the financial statements. It's also in what's called the proxy statement. And the proxy statement is the materials that are provided with shareholder voting. So for example, Elon Musk's $1 trillion pay package being voted on this week, that comes with a proxy statement, and it details everything about the things that shareholders vote on. And a lot of times that's management bonuses, that's who's going to be on the board of directors, that's any particular shareholder proposals that happen, and also the auditor. There's also a vote every year on should we keep our current auditor. And so then the amount of audit fees are also disclosed in the proxy statement. So what we could actually do is if we look at the financials here, we could see how much they're paying KPMG for the audit. And that's always fun to know. If we go to proxy filings, so like this is all the things that the shareholders are voting on in the current year. So they're voting, do we elect the 8 people to the board? Do we ratify KPMG as the auditor? Do we improve the stock incentive plan, the management stock options and stock bonuses for management and also all the other employees? Non-binding advisory basis as basically approving executive pay. They're putting it out there. They're letting shareholders have the say on pay vote as part of the SEC rules. And then also approving any other business that might occur at the annual shareholders meeting. So let's see. And so this is what they're paying KPMG to audit the Cheesecake Factory. $1.4 million, all of their fees, $900,000. Big public company out of the LA office. I'd assume that they probably have a year-round audit team working on this, on the Cheesecake Factory. And they're probably on maybe 3 or 4 other clients too. But it'd be a specific, when you go work for Big Four firm, basically you get put on a team, tax or audit, and then there's also industry groups. So in audit, you could be working in the restaurant industry, which could generally be also in the consumer industry, which would also be in the sort of consumer and manufacturing industries. Or you could be in the energy business and work on oil companies, healthcare business, work on healthcare companies. And so whatever, it's important to consider this when deciding where are you going to work. It's what career opportunities do you want to have in the future? Because if you're working in public accounting, you're either going to stay working in public accounting forever and become either a partner or a highly paid director or manager or whatever, or you're going to work for one of your clients. Those are the 3 career pathways, or you're going to quit accounting. Those are the 4 career pathways in accounting. And so if you can look up all the public companies in the area and see who are their auditors and who do I want to work for. If you really want to work for the Cheesecake Factory in their financial reporting department, that's how you would get there. I don't know why that would be your specific dream, but if you really wanted to, that's how you would do it. So, and it's also fun to look up because then you can see how much are they making and then kind of assume how much the partners are making off of this too, and how profitable is the engagement, because it is all about how profitable an engagement is. That's what an auditor tax job is called. It's called an engagement. So it'd be the audit engagement for the year. And then the tax engagement, that'd be included in all the other fees. That'd be the tax services that they provide. So any questions on how this all works? It's fun, right? So yeah, thanks everybody.